Hi, I'm Russell. Today I will talk about the part 11 of our group project with my team member. First of all, the question one. The null hypothesis portfolio return are equal to zero. The average return of the portfolio is zero. This is independent that investing based on the chosen characteristic does not yield significant excess return. Alternative hypothesis portfolio return are not equal to zero. The average return of the portfolio is not zero. They imply that investing based on the chosen characteristic can yield significant excess return. I can draw conclusion regarding this hypothesis. If the returns are significantly different from zero, I can reject the null hypothesis and support the alternative hypothesis.
Thank you, Russell. Now I'm Jingshuan Xiong, and now I'm going to represent of the question two. The portfolio contract approach employs a long-short portfolio and include the long-short equity approaching, which is investment strategy influence in the long-term position in company project, increasing the value in the short position and the stock decreasing the value. The long position refers to the act of the pricing equity that are project to increasing the value, hence generated the perfect from the upward movement. A short position refers the act of selling borrowing security from the Berkshire business subsequently repricing them to a cheap price in order to generate a profit. The subject of the long-short equity strategy is to modulate the market risk by capitalizing the upward movement in the stock price through the long holding and the downward movement through the like the long position. Although there may be expectation the technique should be be profitable overall, but the long-short equities widely use the liquidity alternative strategy in the hedge fund, which many then employing the market neutral approaching where the value of the long and short position is balanced. So the long short equity fund and equity market neutral, which is EMN fund, have the distinct strategy. While the long short equity fund aim to generate return by the holding both long and short position in variance equity. Then the EMN fund focus on the capitalism on the price difference by trading closing connect firms with similar futures. So while it offered the opportunity for the great profit, it also entail increasing the volatility and the risk of loss. So particularly during the period of the market instability, the long-short equity strategy 2024 typically indicates strong performance during the trading market or the period of increasing the volatility, which include significant fluctuations in individual stock price. So now to start the loading the fundamental data into the code and utilizing the data form to calculate the monthly volatility. The necessary data package including the project 2, ETL as ETL, import U onto, import S1S, import copy, import panda as PD, and the purpose of this function is to display the sequence of steps and compute the overall variability of the stock and a link to each month's return table. So they have three priming functions utilizing, which are the VOL input, sanity check, VOL COL, the merging table. The functions are the capitalism of computing table stand lessons. So the monthly valuation, the margin table to combine the monthly viability and the yield. Subsequently, the calculation can be performed, which is on the screenshot. So additionally, within the portfolio package, it's necessary to input the following models like the Z Project 2 ETL and Z Project 2 Characters as CHA, Panda SPD, NUMPY as MP, until and import S1S as shown on the screen 2. In the beginning, is import to verify the conduct of DFCHA and chart name. So the DFCHAs represent a graphical representation of the monthly yield and monthly return. The function chart name verifies if like the given chart is violent and if the index of data form has monthly frequency. It's necessary to be indicate the test produced in order to conform. So upon approaching the discern outcome, the displays will establish the messages sentinel check for input for all long-term portfolio contraction past. Next, the import of DF reshape function is re-argue the ret, VOL, and the stickers values, which is image 3 on the left hand side. So choose all of the stickers and generate a new data form table to increase over the each stocks. So the subsequence of the produced is stock storing, which intends the coloristic, the tract of each year and each month into the coordinate. The resource is displayed as seen in the screenshot on the right hand side. So determine the portfolio yield by using the factor ranking of the long-short compound to project the set of functions within the highest factor and sell the function with the lowest factors. Therefore, apply the early shortened data form, especially for the variance chart name and Q. The use tag is on the screenshot, and the chart display existing value for the long-short combinations, namely the short positions, which is EWP rank 1 and EWP rank 2. So typically, once you finish the step methodically above, it's necessary to the platform to do the sanity check in order to identify any potential problems. Next, verify the specific data from type and subsequent argue the data based on the indicate future values. And finally, to calculate the yield for the long-short combination.
Go to question 3. The mean of the portfolio return is 0.0073. This is indicates that on average, the long-short portfolio generates a monthly return of 0.73%. This positive average return suggests that the investment strategy based on the total volatility may be profitable. The t-statistic of the portfolio return is 1.3847. The t-statistic helps to determine whether the average return is significantly different from 0. Generally, a t-statistic above 2 would indicate stake significant at the 5% level. In this case, the t-statistic of 1.3847 is below this threshold. That suggests that the average return is not statistically significant at the commercial level. Therefore, we cannot confidently conclude that the long-short portfolio's average return is different from 0. The number of observations in the portfolio return is 235. That indicates that there are 235 months return observation uses analyze. A large number of the observations generally provide more reliable statistical inference. will the long-short portfolio show a positive average return of the 0.73%? The t-stick indicates that the return are not significant. Therefore, based on the output of the part 9, I cannot conclusively infer that the investor strategy based on the total volatility yields significant excess return for the analyst or a longer time period may be necessary to draw more robust conclusions. Questions 4. I think it's not reliable. Based on the results from the part 9, I have a reservation about the reliability of the findings. The average return of the long-short portfolio is positive, which is encouraged, but the statistic is below the commercial threshold significance. The impact that the observed return may be due to the random chance rather than a general effect of the investment strategy. Additionally, the number of the observation 235 is moderately large, but the lack of statistical significance suggests that there may be the substantial variability in the return or a potential issue with the underlying data or methodology. Therefore, while the positive average return is a good sign, the inability to demonstrate significance means we should caution in interpreting this result are reliable evidence of a successful investment strategy. Further investigation, first of with more data or refined models, is a need to draw a more definitive conclusion. The last question, question 5, based on project 2, there are several areas for the further work that I would like to pursue. First, I would explore increasing the sample size by extending the time period or including more stock enhance the robustness of the results. Additionally, we found the most technology for calculate total volatility and explore alternative measure of risks could provide deeper insight. It would also be beneficial to perform robustness checks, such as use different quantity. So has varies the frequency of return calculation. Furthermore, conduct of all of sample tests and course validation could help assess to stress predictive power and reliability. Lastly, integrate other stocks characteristics and implementing a multi-factor model could improve the investment strategy performance and provide a more comprehensive understanding of the driver behind the returns. The step would help ensure that the conclusion drawn from the analysis are both relevant and actionable.
And there is our reference list. Thank you for your listening.